Businesses today don't operate in isolation. They are deeply intertwined with the environment and society. Investors, regulators, and stakeholders are demanding clear insight into these impacts. Enter IFRS S1 and S2, transformative standards for sustainability disclosures. Today, we are going to deep dive into these standards with detailed methodologies, metrics, and real-world examples. Get ready for a thorough yet practical understanding of how IFRS S1 and S2 can redefine corporate reporting. Why are IFRS S1 and S2 game changers? Now, before the introduction, the corporate world was fragmented by frameworks like GRI, ISSB, and TCFDI. While valuable, these lacked standardization for financial markets. IFRS S1 and S2 create a universal baseline for sustainability-related disclosures, ensuring comparability and clarity for investors globally. On June 26, 2023, the International Sustainability Standard Board (ISSB) unveiled its first two sustainability disclosure standards: IFRS S1, which is General Requirements for Disclosures of Sustainability-Related Financial Information, and IFRS S2, which is Climate-Related Disclosures. These standards address the growing demand from investors, creditors, and stakeholders for consistent, comparable, and verifiable sustainability-related financial information. Now let's look at IFRS S1. IFRS S1 sets out the general requirements for disclosing material information about sustainability-related financial risks and opportunities. It's like the framework's backbone, ensuring companies provide materiality-based disclosures about how sustainability impacts their financial performance and strategy, and information that's consistent with other financial disclosures. Now, details on connection between sustainability risks and financial impact. For example, we can look at materiality in action for Tata Steel. Tata Steel's annual sustainability report highlights material risks like carbon pricing and resource scarcity. By identifying material sustainability-related risks, they provide detailed financial implications for stakeholders, demonstrating alignment with IFRS S1 requirements. IFRS S1 also focuses on sustainability-related financial disclosures with specific requirements for its four pillars, which is governance, risk management, metrics, and targets. Now let's break it down. For governance, it ensures transparency on how sustainability-related risks and opportunities are managed at the board and executive levels. Now, disclosures required are governance structure, how responsibilities are allocated within the organization. For example, Shell discloses that its executive team regularly reviews the integration of sustainability into business strategy and its performance against net zero goal. The metric for the same could be frequency of board reviews on sustainability, which can be quarterly, semi-annually. The second pillar is strategy, which shows the interplay between sustainability risks and opportunities and the organization's ability to create value. Now, the disclosures required are identification of material sustainability issues, which is based on double materiality. Now, that is financial materiality, which is impact on enterprise value, and environment and social materiality, which is impact on external stakeholders, and its integration into corporate strategy. For example, its strategy to reduce Scope 3 emissions from supply chains by collaborating with suppliers and investing in regenerative agriculture. Now, the metric for the same can be percentage of revenue derived from sustainable product portfolios, of which for Unilever is 62% according to its 2022 sustainability report. The third pillar is risk management, which provides clarity on how sustainability risks are identified, assessed, and mitigated. Now, the disclosures required are companies' risk identification framework, for example, Costco or enterprise risk management framework. Assessment techniques such as heat maps or risk matrices are disclosed. For example, HSBC uses a proprietary risk management framework to assess portfolio exposure to climate risk, integrating insights from IPCC's climate model. The metrics can be percentage of assets under management screened for climate-related risks. And as far as HSBC is concerned, it's 85%. The fourth pillar here is metrics and targets, which quantifies progress and accountability using standardized metrics. Now, the disclosures required are industry-specific KPIs. Example, water usage per ton of product. GHG emissions per unit of energy produced. For example, Tesla discloses its gigafactory's water consumption, which is 3.6 cubic meters per car versus industry average of 5. Now, metrics can be specific reductions achieved. For example, 25% reduction in water use from the baseline year 2050 for Tesla. Now let's shift gears to IFRS S2, which deals exclusively with climate-related financial disclosures. And here's how it's structured. First is GHG emission requirement. Disclose scope 1, 2, and 3 emission in metric tons of CO2 equivalent. The framework to be used is GHG Protocol Corporate Standard. You may watch my YouTube videos for the same. Now, example, we can take Walmart. Walmart's comprehensive climate disclosures include scope 1, 2, and 3 emissions. They also break down net versus gross emissions, highlighting the impact of carbon offset projects. Their alignment with the greenhouse gas protocol makes them a good example of IFRS S2 compliance. Second parameter in IFRS S2 is scenario analysis. Now, the requirement for scenario analysis is to assess businesses' resilience under various climate scenarios, which is 1.5 degrees centigrade or 2 degrees centigrade of global warming. The framework to be used is climate models given by IPCC, which are two. One is RCP, which is Representative Concentration Pathway, and SSP, which is Shared Socioeconomic Pathway. Now, example can be BP's scenario analysis, which assesses revenue impacts under a rapid energy transition scenario. Now, the metrics for the same is projected percentage decline in asset value. For example, 15% under 2 degree scenarios for BP. Third is financial impact of climate risks. And the requirement is to quantify how physical risk, for example, extreme weather, and transition risk, for example, regulatory shift, affect financial performance of a company. For example, reports that a potential carbon tax of $50 per ton could increase annual costs by $1 billion. Now, the metric is financial exposure to carbon pricing. For example, $10 per ton in low carbon scenarios versus $50 per ton in high carbon scenarios. Then we have climate resilience metrics, where the requirement is to disclose progress on adaptation strategy. For example, a mining company invests $500 million in water recycling infrastructure to mitigate drought risk. The metric for the same can be percentage of operations protected against physical climate risk. For example, 80% by 2025. While the benefits of S2 are clear, implementation comes with challenges. Scope 3 data gaps. Tracking indirect emission is complex and dependent on supplier data. Scenario modeling expertise. It requires advanced analytic tools and climate expertise. Cost of compliance. Initial investment in systems and personnel can be substantial. SMEs struggle to calculate Scope 3 emissions without robust supplier collaboration, delaying their compliance timelines. Now, here's some good news for companies transitioning to this standard. The ISSB is offering transitional relief. In the first year, companies only need to disclose climate-related risks and opportunities. Comprehensive sustainability disclosures start in the second year. Jurisdictions must endorse these standards before they become effective. This approach ensures businesses can focus on high-quality climate disclosures initially and gradually expand their reporting. You might wonder how IFRS S1 and S2 compare to existing frameworks like TCFD and GRI. Now, here's a quick comparison. TCFD, which is Task Force for Climate-Related Financial Disclosure, focuses on climate disclosures, which are now part of IFRS S2. GRI emphasizes broader sustainability impact. While IFRS targets financial relevance, ISSB aligns well with IFRS's industry-specific approach. The ISSB has drawn from these frameworks to create a global baseline for sustainability disclosure. For companies preparing to adopt IFRS S1 and S2, here are some practical tips. The first is start early. Assess existing data and identify gaps in sustainability reporting. Engage stakeholders. Align internal teams and external advisor on disclosure requirement. Leverage technology. Use reporting tools to streamline data collection and analysis. IFRS S1 and S2 mark a significant step towards integrating sustainability into mainstream financial reporting. They are not just about compliance, they are about enabling businesses to create long-term value while addressing global challenges like climate change. This video insightful. If you found, don't forget to like, share, and subscribe. Let me know in the comment what you think about these new standards. Until next time, stay informed and stay sustainable. Thank you.